Have you ever wondered why Warren Buffett, one of the most successful investors of all time, just sold off his entire stake in the S&P 500 ETF? Yeah, that's right. He completely bailed out of $SPY and $VEO. As an investor, you've probably heard time and time again that Buffett's the guy to follow, right? But now, he's walking away from an entire market segment. What does that mean for us? Should we follow suit? Or is this just one of those moves that only makes sense if you're a multi-billionaire with more cash than the US Treasury? Let's dive in and see what's really going on here. Okay, so here's the scoop. Warren Buffett and his company Berkshire Hathaway just sold their holdings in the S&P 500 index funds, specifically $SPY and $VOO. And let me tell you, the numbers here are staggering. The total amount they had invested in those funds was around $48 million. Now, for a company worth about $270 billion, $48 million might seem like pocket change, like selling a single Starbucks coffee at a family gathering. But still, the fact that Warren Buffett, of all people, who's built his empire by investing in the stock market, is pulling back from the S&P 500, well, that's worth a second look. But before you freak out, let's break this down a little bit. This wasn't some dramatic exit from the market. In fact, when you look at the big picture, this move probably wasn't as huge as the media might make it seem. Berkshire's stake in $SPY and $VOO wasn't even a blip on the radar of their entire portfolio. Think of it like when you clean out your car and find a penny under the seat. You're not exactly walking around boasting about it, right? It's just a tiny piece of the puzzle. But here's the twist. Why sell off that tiny piece of the pie at all? Why not just keep it around and let it grow? Well, here's the thing. Buffett's not the type to play the market the way most people do. He's all about value investing, finding individual stocks that are undervalued and have the potential to grow steadily over time. He's not out here trying to time the market every time there's a new buzzword in the financial world. And let's face it, if you're looking to follow the crowd and play the buy the index game, that's not really Buffett's style. You see, Buffett's approach has always been about looking for the diamonds in the rough, not just buying whatever's popular. He's always talked about how index funds, like the ones tracking the S&P 500, are a great place for the average investor to park their money, especially if you don't have the time or expertise to pick individual stocks. So, when you see him backing away from the S&P 500 and VOO, it raises a lot of questions, doesn't it? Is he losing faith in the market? Is he signaling that we should all start pulling our money out of those ETFs? Well, I'm here to tell you, don't panic. We need to look a little deeper. First off, let's talk about why Buffett even holds so much cash in the first place. It's not because he's scared or doesn't believe in the market, far from it. Cash is actually one of the most powerful tools in his investment playbook. Let's take a quick trip down memory lane. Remember the dot-com bubble in the late 90s? Buffett sat back and watched as tech stocks skyrocketed to ridiculous levels. And when the 2008 financial crisis hit, guess who was sitting on a mountain of cash, waiting for the perfect moment to strike? That's right, Buffett was ready to pounce while everyone else was panicking. Buffett has always said that having cash on hand gives him the flexibility to make fast, strategic moves. It's like being the first person to the buffet. You get the best pick of the options before they run out. The Globe and Mail even wrote a piece about this, saying that Buffett uses cash not just for defense during tough times, but for offense when he sees an opportunity to pick up great assets at a discount. That means when other investors are out here selling in fear, Buffett's out here buying with confidence, knowing that he has the liquidity to make big moves without worrying about selling other assets at the wrong time. So, what does this mean for us? Well, when Buffett holds cash, it's not just a sign of him sitting on the sidelines, it's him being ready to take action when he sees a bargain. And he's been doing this for decades. For example, during the 2008 crisis, while others were losing their shirts, Buffett swooped in and bought up iconic companies like Goldman Sachs and General Electric at fire sale prices. Those investments turned out to be huge winners. Alright, let's shift gears and talk about the financial sector for a second. It's no secret that Buffett has historically been a big fan of financial stocks, American Express, Wells Fargo, Bank of America. But lately, he's been trimming his exposure in this area. For example, he reduced his stake in Bank of America by about 11%, selling off 11.5 million shares, bringing his total stake down to 68.2 million shares. He also cut his positions in Citigroup and Capital One, which are two big names in the banking world, so why the change? What's going on here? Well, if you look at the financial sector as a whole, there's been a lot of turbulence. With rising interest rates, inflationary pressures, and some pretty big regulatory changes, the financial sector has been under some stress. Buffett has always been a fan of long-term stable investments, and right now, the volatility in the financial markets may not fit his style. He's trimming his exposure to the financial sector, which could signal his concerns about the overall health of the banking system, or maybe he just sees better opportunities elsewhere. Speaking of better opportunities, let's talk about Domino's Pizza. Now, this is a bit of a surprising move for Buffett. He's never really been known for jumping into the fast food industry, but he recently increased his stake in Domino's by a whopping 90%, from about 1.28 million shares to 2.38 million shares. Now, I'm no expert, but I've got to say Domino's isn't exactly the first stock I would think of when it comes to Buffett's investments. But it's been performing really well, especially with the rise in delivery services and online ordering. They've been able to grow steadily, even in the face of a competitive market. And let's face it, who doesn't like pizza, right? Domino's is just one example of how Buffett's investment strategy isn't just about traditional industries like banking and insurance. He's been branching out and finding solid opportunities in unexpected places. But hey, if pizza is what's working, then more power to him. It's just funny how his strategy is so flexible. You never really know where he's going to put his next big bet. So, what's the takeaway from all this? Should we all start pulling our money out of the S&P 500? Should we follow Buffett's every move? Well, not exactly. Remember, Buffett's entire strategy is about finding value in specific companies that have strong fundamentals and long-term growth potential. If you're a regular investor like most of us, don't go chasing after every move Buffett makes. Stick to a strategy that makes sense for your financial goals and risk tolerance. And as much as I love Buffett and his wisdom, let's be real. Timing the market like he does is not something the average investor should be doing. He's in a whole different league. But that doesn't mean we can't learn from him. What he's always preached is simple. Invest in what you understand, be patient, and avoid trying to time the market. And above all, make sure you've got a solid long-term strategy. That's why he still recommends low-cost index funds, like the ones that track the S&P 500. They're easy to manage, low-cost, and they offer exposure to the entire market, which over time has proven to be a winning strategy. So don't panic just because Buffett sold off a small portion of his holdings. He's not giving up on the market, he's just positioning himself for what he sees as the next big opportunity. And as for you, stick to your long-term plan, do your research, and remember, investing is a marathon, not a sprint. Whether you're buying stocks or index funds, it's all about being smart, staying patient, and having that long-term vision. Now, if you found this video valuable and you want to diversify your investments beyond traditional stocks and bonds, I have just the thing for you. Even though I believe that investing in a low-cost index fund is the best long-term investment for the average Joe, the benefits of solid physical gold are hard to deny. I think of physical gold as insurance against unpredictable times, and I'm not the only one. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, central bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. I found a company that allows ordinary Americans to own and securely store physical bars of gold as part of their IRA account. The best part is that they're giving away a free guide to teach you all about investing in solid physical gold. If you want to learn more about how gold can protect your retirement savings, just click the link in the description to receive a completely free gold IRA guide.